Good day, students. Once again, I am continuing with the videos that I'm doing and hoping that they are beneficial to you, and some students, they do appreciate them. Therefore, now I do it for those who are really in need of them. And I will be doing question 3, which is named Delicious Cereals Pty Ltd. And this question comes from the 2017 question bank. And before I read anything, I always prefer to go straight to the requirements so that I am informed of what am I required to do. First requirement says that I am required to determine the total budgeted contribution per product type by preparing the budgeted marginal cost statement of Delicious Ltd. And be mindful that the marginal cost statement only takes into account the variable manufacturing cost as the cost of production. So now when you're calculating the cost of production using the marginal cost statement, we only take into account the variable manufacturing costs, and that become the cost per unit and the total cost. And this is at the 31st of March in the year 2016 in as much details as possible. Then after, the total column is not required, and we're required to round off to the nearest tens. Secondly, number B say that we are to calculate the budgeted fixed manufacturing overheads allocated to both the corn and the cereal, which are the corn cereal and the whole wheat cereal, meaning we have two products using the current basis of allocation. So now we'll be allocating our fixed manufacturing overheads using the current base of allocation. And it is likely that the current base of allocation is the traditional method. Then number C says we are to calculate the actual fixed manufacturing overheads per unit for the year that end on the 31st of March in the year 2016 for both the corn cereal and the whole wheat cereal using the activity-based system. As I said, that under number B, they are using a traditional method, and under number C, we are using activity-based costing or system of allocating overheads. Then after, we are required to assume that there is no opening and finished inventory units. Therefore, now we are to calculate the deceased budgeted or total required budgeted units for the year that end on the 31st of March 2016 in order to break the even on the budgeted fixed cost for the year. So now we are calculating the break-even point for this company. Then after number E, we are required then to do the variance, which is the sales price variance, where we look at the selling price. It says price variance. Then after, this sales price variance is only for the whole wheat cereal, meaning only for one product. Then after, we are required to do the direct material wheat usage variance. So that means it's only for the wheat product. Then after, direct labor rate variance, where we look at the rate of labor only. And this is for the corn cereal only. Then after, fixed manufacturing overheads expenditure, this one is just budgeted fixed cost minus actual fixed cost. Is one of the very easiest variance to grab marks whenever such variance is required in any assessment. So now I know that in my first requirement, I have to do the marginal income statement. So now in doing the marginal income statement, I know that I have to be able to calculate the cost per unit for the product, which is the variable manufacturing cost. Then after doing that, I also have to take that and I multiplied by production in order for me to get to the income statement, because income statement is not per unit, but it is in total. So now if we just scan or have a scan over this question, you can see that this question is not divided into divisions. So information is bit clustered up and down. So now if information is clustered like this, or it's very dispersed, so now you need a strategy on how to attempt a question of that nature. We can say that there are no divisions. Information is that provided in any random approach, if I may say so. However, we do have additional information that is stipulated, and we also do have the notes. So now that is the only way our information is classified. Then after that, you can see that we do have our fixed manufacturing overheads, and that have been recorded separately. Yeah, so that is how this information is being allocated to us. So now let us go to the beginning. So we'll need to make sure that we structure our information according to the costs per unit, so that it becomes easy for us to get to the easy way of calculating the required information. First, it says Delicious Cereals Pty Ltd is a small size company that produces and sells two types of cereals, which is corn cereal, which is abbreviated as CC, and whole wheat cereal, which is abbreviated as WC, to the major retailers. And they say each of the two types of cereals are sold to retailers in kgs or in units of 1 kg, meaning 1 kg is 1 unit per box. So now obviously they are selling it in a box, meaning this cereal must definitely be packed in a box of 1 kg. And they say the company operates from the Centurion area in Pretoria, with most of its clients situated in and around the Gauteng region or province. And DC makes use of an absorption costing system. So now this company is making use of an absorption costing system. And just to remind you that an absorption costing system is a system where the company includes fixed cost in the calculation of their production cost. So now, although the company is using or making use of the absorption costing, but we are required to calculate the marginal costing, meaning the marginal costing is the system that does not take into account the fixed cost. So that is something that we need to be mindful of, that the company is using absorption, but the first requirement requires us to use or to do marginal income statement, not absorption income statement. Then after it says, and all its inventory are used or are valued using the first in first out method, which is FIFO. And we are given the extract of the from the budgeted and the actual results for the year that end 31st of March. So we have our sales, which is budgeted and actual. We have our opening inventory 1st April 37,800 and 37,800, which was also actual. Then we have our manufacturing cost for the year, and this is our total manufacturing cost budgeted and actual. Then we have our selling and administration cost, which is 100,000 and 107,000 actual cost of selling and admin. And most of the times this cost is split into fixed and variable. And when I'm saying this cost, I'm referring to the manufacturing cost. This is normally classified or divided into fixed and variable. So now they have to tell us perhaps later on which portion of the overheads is fixed and which portion is variable. Then also when it comes to sales and distribution, there is normally a component or the component which is fixed, then there's also the part of this cost that is variable. So now I'm also waiting to get that information. If I don't get, however, I'll listen to whatever is provided to us. So now let me start to notes number 1. The first note says to us that the budgeted annual, which is the budgeted annual sales volume, whereas 100,000 and 50,000 rands for CC and whole weight respectively. And they say the actual sales volume, whereas they were budgeted, So now meaning what that we budgeted became the actual sales volume as it was budgeted. And they are saying that it is for both products that the budgeted was the one that was actually sold. So now we have budgeted and the actual sales. So we do have sales that are given to us in terms of units. And it further say that selling price were budgeted at 30 Rand per unit for product CC and 35 Rand per unit for product WC. And from this point, I think I have to classify my information according to the products that I have, more especially when it comes to the cost aspect of this product. So now I want to have my heading to say I have two products, which is CC and product WC. So now I want to say I have sales per unit. Just provide my cost per unit, sales per unit. And I am told that my selling price per unit was 30 Rand for product CC and 35 Rand for product WC. So now let me have that 30 Rand and 35 Rand, which is budgeted for the two products. Now I will take into account the number of units that were budgeted to be sold a bit later on, when I'm calculating the either closing inventory when closing inventory is not provided. Then now it further says that throughout the year, CC units were sold in its respective budgeted selling price. So now remember, product CC was budgeted to be sold at 30 Rand. And they say throughout the year, this product was sold as it was budgeted. So now if it was sold as it was budgeted, therefore it means the actual selling price of product CC was the same as budgeted. However, for product WC, which is whole wheat, they say the actual selling price was 38 Rand. So obviously this is an indication that there was a variance of 38 Rand when it comes to product WC. And now if you look at this part, it's also in line with the question that we're required to do. Because in the requirements, when it comes to the variance, we're required to calculate the sales price variance for product WC, which is whole wheat. Why they require us to do that is obviously because there was a variance with regard to this product. Because what they budgeted in terms of selling price as 35 Rand was no longer the same as 38 Rand. It does not mean that if there is no variance, you will never be required to do the calculation of the variance. You can still be required to do so. Then now we are given information that says that the budgeted sales mix is 2:1 for product WC and CC. That is our product mix or production mix. Then now we have the opening inventory, which is on the 1st of April, and that opening inventory was 1,000 units and 500 units. And now I think I can be in the position to calculate perhaps the closing inventory. Let me just go to a page where I will do the calculation of the closing inventory, in case the closing inventory is not provided. I have two products, which is CC and product WC. Then I say calculation of the closing inventory, because most of the times the closing inventory is not given. Closing inventory. In calculating closing inventory, we have the opening inventory, and our opening inventory is 1,500 units. So now we have our opening inventory as 1,000 units for product CC and 500 for product WC. And they say that at the budgeted cost of 24,600 and 13,200. So now they are telling us that the cost of this opening inventory is 24,600 and 13,200 rands. And it further say that the fixed manufacturing overheads were absorbed at the rate of 1 Rand 20 cents per unit for the 2015 financial year. Remember, this opening inventory is for the 1st of April 2015, which is now the beginning of the current budget period, or the current budget period, in fact, yes. So now they are saying included in this opening cost, the cost of 13,200 and the cost of 24,000, included there was R1.20, which is the fixed part per unit. As they say that the fixed cost manufacturing overheads were absorbed at R1.20. And the question is, why do we have the amount of R1.20 included as the fixed cost in the opening inventory? It's because, and also the question is again, why are they giving us all this information? It is because we are required to calculate the marginal income statement. As I said to you, that the marginal income statement does not take into account the fixed cost in the calculation of production cost. So now that means the opening inventory that is given to us and the opening cost that is given to us is inclusive of the fixed cost. And the reason why that is inclusive of the fixed cost is because the company is currently using absorption costing system. However, they are not always bound to provide information in absorption perspective or system. They can require you to calculate income statement using the marginal statement, meaning the statement that does not recognize fixed cost in the calculation of that statement or in the calculation of the production cost. So now, meaning we have to remove our fixed cost out of that opening inventory. And how are we going to do that? We have to say R1.20 per unit, and to say how many units are of the opening inventory. We have 1,000 units. Then we say R1.20 times by 500 units of the opening inventory for product WC, so that we can know how much is included in that opening inventory in terms of fixed cost. So now let us calculate the fixed cost. Remember, I still will continue with the calculation of the closing units in this case, but now the question is just drifting me away. As I said to you, that this question is not well structured, so now you might be a bit moving up and down sometimes. So now we are saying calculating fixed cost, or calculating fixed cost. Let me say calculating variable opening cost, because I want to calculate the variable opening cost. Then now I have two products, and my two products are WC and CC. WC, product CC, and product WC. And I am provided with the opening inventory that include the fixed cost, which is my opening cost, and my opening cost is given to me as the total of 24,600 rands. So I take that total of 24,600 as it is, and I record it as 24,600, and I also have to record 13,200. Then now I have to minus fixed cost, because included in this opening there is fixed cost, and my fixed cost is R1.20 times by 1,000 units of the opening inventory. And again, another one is R1.20 times that by the opening of 500 units. Then after now I have to say R1.20 times this by 1,000 units of opening inventory. Therefore now I have to say or deduct 1.2 from that, so that the remainder is only the variable portion. R1.20 times that by 500, it gives me an amount of 600 rands, meaning included in the opening cost were these two amounts, 1.2 and 600. So now that means the adjusted variable, or the variable cost in the opening inventory, or the variable opening inventory, will be the opening cost minus the fixed portion. So now this will be 12,600 as variable opening inventory, or variable opening cost. 24,600 minus 1,200 and this gives me an amount of 23,400. So now this is the opening variable cost, or the calculating the variable opening cost. So now meaning our opening cost now is no longer fixed, it only the variable portion, because you know that the fixed portion was 600. And in calculating the marginal income statement, we don't need, or we don't take into account the fixed cost. So now hence I am eliminating that portion. Then now we proceed on that same note. It says that for the year ended 31st of March 2016, the company had no opening or closing inventory for all types of raw material or work in process. And that is a good information to be given to us. Then now we have the company that had the budgeted production of 101,000 for product CC and budgeted production of 51,000 units. So now remember I said I still have to complete my closing inventory. I have opening plus production minus sales, then this will give me closing inventory. I am doing this because sometimes, or most of the times, we are not provided with the closing inventory. So now if that is the case here, then I'll do the same thing. Remember, the sales that were budgeted were 100,000 and 50,000 rands. So now meaning under my sales, I can just write 100,000 budgeted sales and 50,000 budgeted sales for product WC. Sorry for that, is under closing. My sales are an amount of 100,000 rands and 100,000 units and 50,000 units that were budgeted. And my production, as we have seen, that it was 101,000 rands, 101 units and 51,000 units. Let me just confirm that we had 101 units budgeted and 51,000 units that were budgeted. So now if you say opening plus production minus sales, that will give us the units of the closing inventory. Then we had our opening as 1,000 units plus 101,000 units minus 100,000, and this gives me a total of 2,000 units of the closing inventory for product WC. 500 plus 51,000 units minus units of 50,000 that were sold. Therefore now this gives me 1,500 units that were sold. In fact, units that were at the end of the period. So now closing is 2,001.5. So we have calculated the closing inventory units, and we have calculated the opening cost, which is the opening variable cost of inventory. And remember, there was another part where I said all the cost per unit, selling price per unit, all the cost per unit will be recorded here. So now whenever they give me that information, I'll come and allocate it here. So now I go according to this question. As I said, that a question of this nature is normally not a very good question, because it can confuse a student who does not have the good strategy to attack the question. Then now it says these budgeted units are equivalent to the company's annual production capacity. So now that means the company is producing at its or equivalent to its full capacity. And it says, however, the actual units manufactured were 105,000 or 100,500, and actual production was 50,500. So now this is the actual production, not the budgeted production. So now remember, I provided information here on the closing based on the budgeted. This was budgeted information. I was not dealing with the actual as per yet. So now in this case, they are giving me the actual information. And under actual, they say actual production was 100,500 and 50,500 for product WC and for product CC. Remember, sales, they said they remain the same. And now when it comes to production, they're telling us that production is different than it was budgeted. So now we can also, if we want to calculate the actual closing units of inventory, then let us do the actual units. The actual units. And before we do the actual units, we need to check the opening units. If did we have the opening actual units. We're provided here with the opening units of 1000, and they did not make mention of the actual units of opening, so that might make things to be a bit complex. So now let us leave that as is so far. So now we will not do the actual because it will just bring us into confusion. So now proceeding in that same note, we go to the next paragraph. Next paragraph, which is paragraph 4, says to us that the budgeted selling and administration cost is 70% fixed and 30% variable. So now, as I mentioned to you that my selling and distribution of 100,000 can be split into fixed and also can be split into variable. So now they are telling us that it is scattered into 70% and 30%. Selling plus administration cost. Then I need to know the portion that is fixed, and the fixed portion is 100,000 times that by 70%, meaning the fixed selling and administration, it is 70,000. And the variable portion of selling and administration will obviously be a total of 30,000 rands, which is 30% of 100,000 rands. So now this will be 30,000 rands. Total of that will obviously give us the amount that we're allocating, which is 100,000 rands of selling and administration. So we have splitted our selling and administration into fixed and the variable portion. Then after it says fixed costs are located in the ratio of 5:3 between product CC and product WC. So now that means the fixed part of the selling and distribution, another one goes to product CC and product WC. Then now we have to split this fixed into the ratio. And the ratio as it is provided to us will be 70,000. So now we are splitting the fixed portion. 5:8. I think it was 5:3. So that will be 5 divided by 8. They said in a ratio of 5:3. There is the ratio of 5:3, so that will be 5 divided by 8. They said the fixed cost allocation ratio. So now we are allocating the fixed cost to the two products that we have. 70,000 times that by 5/8, it gives us the allocation of fixed cost as 43,750, and that will be 43,750 minus 70,000. And that will give us a total of 26,250. Just confirm that is 3/8 times by 70,000, which is 26,250. So now that 70,000, which is fixed, is divided into 43,730 for the first product and 26,250 for the second product. 26,250 and 43,750. If you add the two, you say plus 43,750, it gives us the same 70,000. Please make sure that you always do that, so that if by mistake you have made an error, you can be able to identify your error as quickly as possible. So now that will be the allocation of the selling and distribution in terms of splitting that to fixed and variable. Then now we go to the next part, and remember CC was getting 5 and WC was getting a 3, and we did that exactly. And they say to us that the budgeted variable cost, and now they speak of the variable cost. Remember, the variable cost is the variable element of that selling and administration, which we said it is 30%, being 30,000. And they say that variable component is 20 cents per unit. And remember, variable cost per unit remain the same, meaning they are fixed for both products. Because this variable cost, they relate to selling and administration, so they are fixed. Therefore, now we'll be using the same 20 cents per unit. And remember, our selling cost, our selling and administration, they are related to the units that were sold. The company budgeted to sell that, and they actually sold the same number of units. So now we are calculating the variable portion. Remember, our variable selling is a total of 30,000. So now when we split the variable component, it has to give us obviously the same total of 30,000. So now we are still under selling and administration, the variable part. So now we have the variable selling and administration, the variable selling plus admin. Then we allocate that to product CC and product WC. And remember that variable cost is calculated by saying 20 cents times by 100 units that this company budgeted to sell. Then after we say 20 cents times that by the number of units that this company budgeted to sell for product WC. So now if we do that, it will give us the total of the variable component of the selling and admin. 0.2 times by 100,000 units that were budgeted to be sold. This gives us 20,000 rands of the variable selling and admin. Then after we say 0.2 times this by 50,000 rands, in fact 50,000 units, it gives us 10,000 rands, meaning the variable cost allocated to the two products is 20,000 and 10,000 respectively. So now we can see that the total of the two gives us the same 30,000 that was given to us as 70% of the selling and admin. 10,000 plus 20,000 gives us the same 30,000. So now this had to be aligned, otherwise that will mean there is definitely a mistake in these calculations. However, there is no mistake as per this moment. So now we are done with the notes that were provided to us, and the notes were focusing on the units, splitting fixed and variable, closing and production, actual and budgeted, and the opening stock. So now from here we go to the additional information, and I think from here now there will be talking of the manufacturing cost, because under the notes there was no manufacturing information regarding the cost. So now definitely here they will tell us about the material that is needed, the ingredients for the product, and all that stuff. Then now we go to additional information number 1. It says the primary ingredients for product CC is corn and a wheat. So there is ingredients that is needed, a corn and a wheat. For product CC, we know that whenever we see a corn, which is the material called corn, that will belong to a product CC. And whenever we see a wheat, that belongs to product wheat. So there will be a corn somewhere and there will be a wheat somewhere, which is the cost of manufacturing these two products. So I'm allocating this under the cost per unit, or under the standard cost per unit, or standard information per unit. And they say both product CC and WC uses the same secondary ingredients. So they have primary ingredients and they also have secondary ingredients. And secondary ingredients is made of barley, sugar, and vitamins, and you can see that they are combined. So now let us also take into account the secondary ingredients, which is barley, sugar, and vitamins. So we say barley, sugar, and vitamins. This is what they classify as secondary ingredients, vitamins are needed for these cereals. Then now we go to the next part of the information. They say the combined, meaning combined, they are referring to these three, total of the three secondary ingredients, which are for product CC and product WC. The combined ingredients budgeted cost for the secondary ingredients was 7 rand per unit. So now they say the cost per unit of this ingredients secondary is 7 rand per unit. Remember, it is for both the cereal and the whole wheat cereal, which is corn cereal and the whole wheat cereal. So now we do have the cost per unit already allocated here. Remember, this was already per unit. Then after they say, and the actual cost of the secondary ingredients was 6 rand. This will be important for the analysis of the variance. As I said to you that this information is based on budgeted. It's budgeted info per unit. And is budgeted information per unit. And when I'm saying budgeted information per unit, I'm referring to the selling price per unit, and all this cost here will be per unit. So now I'm basing that on the per unit perspective. Therefore now selling the actual part of 6 rand is for the variance analysis. Then additional info number 3 says the actual corn cost per kg. Remember, this is actual. I'm still busy with the budgeted. The actual corn cost per kg for 2016 was 7.80 rand. And the budgeted, they say now, this is my concern. This is where I'm focusing. I'm focusing on the budgeted first. It says, and the budgeted cost per kg of a corn. Remember, a corn goes hand in hand with the product CC. CC is used in the primary ingredients called a corn. So now when I see the budgeted information, which is 8 rand per kg, remember we're given the kgs, the information in kgs. So the 8 rand, which is budgeted cost per kg, they say that cost per kg is 8 rand. And we need to know now the budgeted kgs per unit, meaning after where we will have to say 8 rand times by the kgs per unit, because this is not per unit but it's per kg. And it says each unit of CC requires 0.5 kgs of a corn. And it says both the budgeted and the actual corn usage, meaning the kgs, this is the usage per unit. That's what they are referring to when they say the usage. Corn usage were the same as the 2016, meaning whatever they budgeted was the same as actual. So now, meaning is the same as 0.5 per kg. So now when it comes to a corn, meaning the cost of a corn per unit will be 8 rand times by 0.5 kgs per unit, because we need 0.5 kgs per unit. However, the cost corn per kg is 8 rand. So now if you say 8 times by the kgs, that will give us the 4 rand of a corn per unit. Remember, a corn is a primary ingredient for product CC, which is the first cereal, not the whole wheat cereal. The corn cereal. Therefore, now we go to the next part. And again, regarding this 8 rand, 7 rand 80 cents, this is the actual information, as they said, the actual corn cost. So now we're looking for the budgeted corn cost per kg, and we multiply that by the usage or kgs per unit, and that gave us the cost of a corn per unit. Then we go to information number 4, which says the wheat. Remember, the wheat is used for product WC, and that was the primary ingredient for product WC, which is the wheat. Now they say the wheat is bought in kilograms. That is good info. The budgeted cost per kilogram is 15 rand 34. That is per kilogram. And now we need it per unit, not per kilogram. Per kilogram is important when you do the variance, and also per unit you can use any of the figures, per unit or per kg. And it says each unit of whole weight requires 0.5 kgs of weight. So now it says the actual cost of wheat was 15.50, which is different from the budgeted. Therefore, now there's a variance obviously there. And it says the actual usage was 0.6 kgs. Remember, the budgeted, in this case, the budgeted was allocated as 0.5. So now we need the cost per unit. Cost per unit will be the cost per kg times by the number of kgs that are required to complete 1 unit of wheat. So now this will be 15 rand 34 cents times this by 0.5 kgs per unit. So now that will give us the cost of wheat per unit of product all cereal. 15.34 times this by 0.5, it gives us 7 rand 67. Remember, wheat is not being used as a primary ingredient for product CC. It's only used as a primary ingredient for product WC. So now we are done with that part, and we go to number 5. Number 5 says to us that both CC, meaning both two products that we manufacture, are sold in small size customized boxes that are made from the same soft carbonated or cardboard, in fact. And so now this is the box I spoke about before. They say the budgeted cost of a customized box is 3 rand per unit. So now this is the cost of the box. Remember, these cereals are sold in a box of 1 kg, if you still remember. They said they sell them in a box of 1 kg. So now meaning this box is also a cost of production or cost of producing these corns or cereals. So now the 3 rand is for both of them. Therefore, now there's a box which is the cost that we have to take into account. And the box is 3 rand for both of them, either the cereal or the whole wheat in terms of the cost. So now they are telling us that the actual cost of the box was no longer the same as budgeted, but it became 3 rand 2 cents. So now that is also indicating another variance regarding the cost of the box that is used to package the cereals. Number 6 is saying to us that the budgeted direct labor rate is 50 rand per hour. So now meaning another cost, remember, our cost of production is made of material, labor, and overheads. So now in this case, we are being introduced to labor cost per unit. And they are telling us that the labor cost per unit, in fact per hour, is 50 rand. So now we need to know how many hours does it take to complete 1 unit of the whole wheat, and how many hours does it take to complete 1 unit of product corn cereal. So now they say now that the budgeted direct hours to produce each unit, meaning the labor hours per unit, is 12 minutes of product CC and 10 minutes of product WC, and all the employees are being paid 50 rand per hour. So now we need to know how much will be the cost per unit. It will be 50 times that by 12 over 60 minutes in an hour. And for the second one, it will be 50 times this by 10 divided by 60 minutes in an hour. So now we are converting the minutes into hours. Then we take those hours, we multiply them by the rate per hour. So it's 50 times by 12 over 60. And this gives me an amount of 10 rand. Then after, which is 10 rand per unit now, no longer per hour. Then we have 50 rand, divide this by 10 over 60, and okay, 50 rand divide by 60 times that by 10, it gives me 8 rand 33 cents. So now this will be the cost of labor per unit to complete these two products. I'll just erase this for space purpose. It is very important to show those calculations throughout. So now I proceed to the next part. I've taken into consideration my my labor cost. Then now it further says to us that the production employees can work interchangeably between the two products. The actual direct labor minutes per unit were as equivalent to the budgeted direct labor minutes per unit of each of the two products. So now the time that they budgeted to manufacture a unit of each product was actually the same as it was budgeted. So now there was no variance with regards to time. However, they are telling us that when it comes to the actual direct labor rate per unit, there was a 5% increase, meaning the actual direct labor rate per hour was 5% higher than the budgeted direct labor rate per hour. Remember now, we previously said that budgeted we had 50 rand, which was per hour. So now if we increase 50 rand per hour by 5%, that will be times that by 1.05. So now if we term that by 1.05, it will be 50 rand times by 1.05, which is 52 rand 50 cents. Meaning the actual labor rate was 52 rand 50 cents, no longer the same as it was budgeted. So now we will compare the actual with the budgeted, and we can see that there is a variance, and we have to multiply that by the actual hours that were spent to manufacture the given products. Then now I will remind you about that when we do the variance on the labor rate, because there's a variance on the labor rate. Then after we go to number 7. Number 7 says the budgeted and the actual variable manufacturing overheads for each of the units was 2 rand. So we can see that we have now our variable manufacturing overheads. If you still remember, once again, I made mention to you that when it comes to manufacturing overheads, there must be a portion that is fixed and there must be a portion that is variable. So now they are telling us now the portion which is variable. When it comes to selling and administration, we have already dealt with this. So now they are giving us only the variable manufacturing overheads. In this case, of which our variable manufacturing overheads is 2 rand. And that 2 rand, it is per unit, which is the actual was the same as the budgeted. So now, meaning we have to go and do calculations now for the variable overheads. Let me first allocate them here. Variable overheads, variable manufacturing overheads is very important to specify, because there's also non-manufacturing overheads. Variable overheads, they are 2 rand for each of the units. So now if you see, we've only taken into account all the variable cost. I'm referring to this cost from here. They are all variable manufacturing cost, all this cost. We have not taken into account fixed cost because we don't need them in the calculation of the marginal income statement. Then now let us proceed on that same note and we'll see what are they saying. Let me analyze in fact this last 2 rand so that I can be able to split the portion of the manufacturing overhead that is fixed. Remember, this amount of 4,005,000 or 254,170, another portion is fixed and another portion is variable. So now I have to extract the portion that is variable. And how do I do that? I have to do my calculations where I calculate my variable overheads and I subtract them from the fixed overheads. So now I have to say manufacturing overheads, and my manufacturing overheads, I need to start with the variable portion. Variable manufacturing overheads. My variable manufacturing overheads for the 2 products, which is product CC and product WC. And my calculation will be 2 rand times and 2 rand times that by the budgeted units to be manufactured. Remember, the budgeted units to be manufactured is the budgeted production of 100 1,000 and 51,000. That is what this company budgeted to produce for the two respective products. So now if I do that, I will say 2 times that by 101,000, and it will give me an amount of 202,000. This will be 202,000. Then after I say 51,000, times this by 2, and I get 102,000 rands. I get 102,000 rands. So now after I'm done with that, then I can calculate my fixed overheads. My fixed manufacturing overheads, which is for the two products. My fixed manufacturing overheads will be calculated by saying a total of the overheads that are given to us, which is 4,254,170, 4,254,170, 4,254,170 minus the variable part, which is 202,000. And in fact I have to deduct both of them because they did not tell me how to split the fixed overheads. So now I have to combine them. I cannot split them for each product. Then now I have to deduct again the 102,000 rands, which is for product whole wheat. Therefore now my fixed manufacturing overheads will be a sum of 4,254,170. Just to confirm the accuracy of that, 4,254,170 minus just space peoples, we deduct 202,000 and we deduct 102,000, and this gives me an amount of 395,000 or 3,950,170. So now this is my manufacturing overheads fixed portion. So now that will be the fixed portion of my budgeted manufacturing overheads, which I am not told in terms of how to split this budgeted manufacturing overheads. I just have to deduct only the variable portion from the 4,254,170 minus 202,000 minus 102,000. That gives me, I think I'm getting a different figure now. 4,254,170 minus 202,000. It's always good to confirm, and 102,000, which is 3,950,170. So now this is my fixed manufacturing overheads of 3,950,170. So now I proceed on that same note and I go to the next step to calculate now again my next information. My next info says, I think we ended under number 7. My next info says that the budgeted annual fixed manufacturing overheads is 200,000 rands, and the actual was given to us as 180,000 rands. And the fixed overheads are based on the allocated or absorbed on the basis of units produced. So now our POR is calculated using the number of units that were budgeted to be manufactured. So now this means in calculating the POR for this fixed cost, it will be based on 200,000. We have to divide this by the total of 101,000 units after we have added 51,000 units, because the total of 101 and 51,000 were the units that were budgeted to be manufactured. So now it means our absorption rate or our predetermined overhead rate was based on the number of units that were manufactured. And this is one of the requirements where they say we must allocate our budgeted fixed overheads based on the current system. The current system is that fixed overheads are allocated on the basis of units manufactured. Then we'll do that together after that. So now we can see that we have fixed manufacturing overheads as a heading again. And I don't want to count this heading yet. I think now I have enough information. Because the next part is they say the company is investigating the possibility of using activity-based costing. So now APC, I will deal with APC when I do the question of the APC. From this point, I think I am able now to respond to the first question in terms of compiling the budgeted marginal income statement. And that budgeted marginal income statement, it is based on the marginal statement only using the variable costs. So now I've already done the calculations. Let me then proceed on that same note. So now let me proceed on that and I do the calculations. Then we are doing the budgeted marginal income statement. We are doing the budgeted marginal income statement. And remember, I have already done all the workings. I have already calculated all the workings and I have all my costs there. From here up to here will give me the cost per unit. And from here up to here, this will give me my cost per unit. So first thing is to calculate my production cost per unit. And this production cost per unit will help me also in calculating the contribution per unit. But now I only need to calculate my cost per unit. My cost per unit, which is variable cost per unit. Variable cost per unit, to be specific, variable manufacturing cost per unit. Variable manufacturing variable cost per unit, which is manufacturing cost per unit. So now my manufacturing cost per unit will be a total of 4 rand plus 7 rand plus 3 rand plus 10 rand and plus 2 rand. And this gives me the total of 26 rand. And for the second product is 7.67 plus 7 rand plus 3 rand plus 8.33 plus 2 rand, and this gives me exactly 28 rand. This is my cost of production per unit. And now since I have done this working, so now it means it will simplify my calculations when I am calculating the marginal income statement. So now I am calculating the marginal income statement, or let me say this is my working number 1 because it is my first working. That is working number 1. So now I have my cost per unit, then I'm doing requirement number A, which is marginal income statement. Marginal income statement, and my marginal income statement is for products CC and WC. And this will have to start with sales, and we know that our selling price, it is 30 rand and 35 rand, termed that by 100,000 units that the company budgeted to sell, and they actually sold as they budgeted. Remember, this was the sales of 100,000 and the sales of 50,000. And if you remember, once again, the selling price is 30 rand and 35 rand budgeted. So now that will be the information that we are using in compiling our marginal income statement. Then now for the second one, it will be 35 rand, and I term this by 50,000 units that this company budgeted to sell. So now it will be 30 rand, term that by 100,000 units, and this gives me 3 million. 3 million rands is the sales revenue for the corn cereal, and 35 rand term this by 50,000 units that this company budgeted and actually sold. It is 1,750,000 rands of the sales revenue that this company budgeted to make at the end of its budgeted period. Then after, I have to say less variable production cost, variable production or variable production cost or variable cost of sales. Let me just say variable cost of sales, and my variable cost of sales will be made of the opening. And my opening was, we did some calculations of the restated opening. If you still remember, we had restated the opening inventory or the opening cost, and we calculated that as 23,400 rands. Make sure that you show your workings, guys, throughout. And I think this will be my working 2 if this was working 1. So let me just do my working numbering now so that I can do the reference. So everything's under working 2. 23,400 is under working 2. 23,400 is under working 2. 23,400, then I have to inform the examiner that this is working 2. And here I had 12,600, which is working 2. They have to go and look at working 2, and they will see that the figures are really from working 2. And there we have 23,400 and 12,600 of the opening variable inventory or variable cost. Then after, I say minus production, and now that I have my cost per unit, I can just say open brackets 26 rand. Remember, 26 rand is working number 1. Then refer to working number 1. Times that by budgeted production, and the budgeted production is 101,000. Remember, my cost per unit was calculated here. This was 26 rand. I termed this by the production cost. So now I have to give instruction to the examiner in terms of where is this 26 rand coming from. Therefore, now this will just be 26 rand times by 101,000, and this will give me 2,626,000. 2,626,000. This will be 2,626,000 rands. Then after, I do another production cost, which is 28 rand times, okay, before that, 28 rand, I tell the examiner that the 28 rand comes from working number 1. Then after, I multiply that by 51,000 units that the company budgeted to manufacture. Therefore, now this will be 28 times this by 51,000 rands, and this will give me 1,428,000 rands. Then after, I still have to take into account my closing inventory. And I know that my closing inventory was made of 2,000 units. And those 2,000 units, they come from working number 2. I think I still remember it was working number 2. Closing inventory, there we had a number of units, 2,000 as closing inventory and 1.5 as closing inventory, and that is under working number 2. So now I'm instructing the examiner where to go. I times this by the production cost, and my production cost is 26 rand. Sorry for the inconsistency. I just started with the units this time around as opposed to the cost of 26 Rand. Again, the cost of 26 Rand come from working number 1. Then after my closing units for the second product is 1.5, which is working number 2, and I term this by 28 Rand, which is working number 1, the cost per unit. Then after now I say 2000 units times this by 26, and it gives me a total of 52,000 rands. This is 52,000 rands, which is the value of the closing inventory by the end of the period. Then after 28 times this by 1.5, it gives me the total of 42,000 rands as the cost of the closing inventory by the end of the budgeted period, which is the budgeted closing inventory. Then after now I need to take into account my variable selling and administration. Remember, this is marginal income statement, so now I have to take into account all the variable costs, but I had to split the variable production cost from the non-variable production cost, because all the costs that I have accounted for so far, they are production cost. However, the part of the admin and selling is not manufacturing cost. These are variable manufacturing cost, but selling and admin is variable non-manufacturing cost. So now I have to say less my selling and admin, less variable selling and admin, variable selling plus admin. My variable selling and admin cost, I think it was 20,000 and 30,000 rands. If you still remember that, it was 20,000 and 10,000, not 30,000. It was 20,000 and 10,000. And I did some calculations of that 20,000 and 10,000, if my memory still serves me. Yes, this is the 20,000 of the variable selling plus admin and the 10,000 for the two products. And now let me go back. This was my working number 2, so it still continues under number 2. No, this is a different case. Selling and calculating, this should be working number 3. Then my selling and administration that goes up to this stage will be under working number 3. So now I will direct the examiner that this figure is coming from working 3, and I also have to specify this is from working number 3 or calculation number 3. It does not matter how you direct the examiner, as long as you are consistent. This will be working number 3. This will be working number 3. Let me just change the color so that one can see that is something different, indication of where is the working coming from. So now from here I can then calculate my contribution straight. I can then now calculate my contribution, and my contribution will be here at the bottom. I will have my total contribution here at the bottom. Therefore, now that will be the end of the first requirement in this question. This will be the end of the required in this question. Remember, there will be a line separating the two here in between, just to make sure that you don't mess up things around. So now let me do the calculations. So now my calculations will be the opening of 23,400 plus production of 2,626,000 minus my closing of 52,000 rands, which I get 2,597,400. I get the cost there, which is my Please keep the workings that you have shown, just because of space for me. I get a total of 2,597,400, and that is the opening. Then after, I will have 12,600 plus production of 1,428,000 minus closing of 42,000, and this gives me 1,398,000. 1,398,000 rands. Therefore, now I have to account for the closing now, for the selling and administration and the sales revenue. Therefore, now I'll have 3 million of the sales minus 2,597,400. Then after, I also have to say minus my selling and administration of 20,000. After deducting that, I get to 382,600. 382,600, which is my contribution. Then after, second product is 1,750,000 minus 1,398,000 minus 10,000 of the selling and administration here at the bottom, the 10,000. Then after deducted that, I get to 342,000 rands. Let me just confirm, 1,750,000 rands minus 1,398,700 or 1,398,000. Then after, let me just check 1,410,000 1,398,000, okay, minus 10,000, and if I do that, I get 342,000 rands. 342,000 rands. So now this will be the contribution that we have at the end of this period. So now I have clearly stated everything, so I just want to reaffirm the calculations of this. We had 28 times by 51,000, 1,428,000 plus 12,600 minus 42,000, 1,398,600. I just did not, 1,398,600. I could identify that there is just one figure that I missed. 1,398,600, just reconfirm that, 1,428,000 plus 12,600 minus 10,000, or minus 42,000 in fact. 12,600 plus 1,428,000 minus 42,000, 1,398,600 minus 1,750,000 plus 10,000. Then this gives me 341,400. Okay, that is just the correction of that. 341,400. 341,400. It's always very good to confirm the calculations, because sometimes might make mistake. So we have 1,750,000 minus 1,398,600 minus 10,000, 341,400. So this will be 341,400 rands as our contribution at the end of this period. Then now from here we have responded wholly to requirement number 8. Then after, we go to requirement number B. If space allows us, then we'll do the workings and calculations here. That might be enough. So we're required under number B to calculate or allocate the budgeted fixed manufacturing overheads of the corn and the whole wheat cereal using the current basis of allocation. And I said to you that the current basis of allocating the fixed cost is that base of the number of units. That is the current base of allocation, where they said fixed manufacturing overheads are absorbed or allocated based on the number of units. So now they say we must just calculate our fixed cost in total using the current basis of allocation. So now we have to say fixed cost, and our fixed cost is for product CC and product WC. And this fixed cost will be allocated by saying 200,000 rands times this by 101,000 units that we budget to manufacture, divide by 101,000 plus 51,000 units. This will be the allocation of fixed cost to the first product. It will be first 101,000 plus budgeted for the second product 51,000, which gives us a total of 152,000 units in our, otherwise the sum of the above part. So it will be 200,000 times this by 101,000 divided by 152,000 units, meaning we have to allocate 132,895 to the first product. Second product, it will be 200,000 times this by 51,000, divide this by 152,000, and it will give us a total of 67,105. If you say 67,105 and you add 132,895, it should give you 200,000, and you can say that is exactly 200,000 that we have allocated using the current basis of allocation. So now we have done already the second requirement, which was requirement number B. So now we go straight to requirement number C. Requirement number C states that we should calculate the actual. Remember, there were two fixed costs. There was budgeted, which was 200,000, and that was requirement number B. And there is actual, and the actual is 80,000. And now we are required to calculate the actual fixed manufacturing overheads per unit. Take note, for the year that ended on the 31st of March 2016, for both CC and whole wheat using activity-based costing, ABC. And I said to you that I don't want to read this information because it is based on the activity-based costing, this one. So now this is where we have to go to. It says an initial analysis of the actual fixed manufacturing overheads established the following relationships between the overheads and the activities. So we have direct material ordering, we have factory rent, we have packaging process, and quality inspection, which is split up to a total of 180,000. And if we look at this total of 180,000, is exactly the same 180,000 that come from that actually fixed cost, and this is the same 180,000. So indicating that this is the actual fixed cost that we are to allocate. But now in this case, they are giving us from an ABC perspective. So now in doing that, we have to split it to the two products, which is product WC and product CC. So we have two products, product WC and product CC. We have to allocate this based on the proposed system, which is ABC, where our fixed costs actually are allocated into material or direct material ordering, which is direct material ordering, and the second one will be based on the factory rental. Second one is based on the factory rental. So now this will be factory rental, and the last one will be based on the packaging process of 15,000, or packing process. Packing process is total 15,000, and the last one is quality inspection of 20,000. So this is quality inspection. This is how our cost can be allocated. So now we have this cost. They have to tell us the cost drivers. They gave us the area or activity area, but we need the cost drivers. They say in the first cost driver that in the total company order, or in total the company orders direct material 10 times a month for each of the products CC and WC, which in total is 20 per month. And now be mindful of the months. So now they give us information on a monthly basis. So now we have to split that. Obviously, even if we split it per annum, it will still be the same thing, because 20, which is 10 over 20 is a half. So now we have to split our material ordering. Remember, they said direct material is 10 times ordered, and that is the cost driver of the material ordering of 25,000 rands. So now we are allocating material. We are allocating direct material, and this will be allocated in the base of 10 times 2, which is 20. Therefore, now we start with the product CC. It will be the cost of 25,000 times this by 10, which is the number of orders for product CC, and the total orders for the two products, which is CC and WC. So now, which is 50-50, and if we do that, it will give us the total of half of the 25,000. 25,000 times this by 10 orders, divide by 20 orders, and this will give us 12,500 rands that will be allocated to both of the products, because it is 50-50 to both of them. So now it will be a total of 12,500, and also for the second product it will be 12,500. The only thing that you can just change is the name of the product, then it becomes WC is the same 12,000, because they also had 10 orders on a monthly basis. So now this was the allocation of the direct material ordering. I'll just erase all the workings only for this ABC question. The second part now, they are to tell us about the next cost driver for the next cost activity. They say under number 2 that total factory rent is allocated in a ratio of 4:3 to product CC and product WC, which is the 3 part. And the cost for this is 120,000 rands, which is the rent. So we have to split the rent in that ratio perspective of 4:3. So now we are to split rent, and we split rent to product CC. And the rent that we're splitting is the amount of 120,000 times by 4/7, which is 4 plus 3 is equal to 7 of the ratio. So 120,000 times this by 4/7, it gives us the amount of 68,571 that will be allocated to the next product, which is product CC in this case. So now that will be a total stipulated, and it will be 67,571 rands. Then allocate that 67,000 571. Let's recalculate 120,000. Times this by 4/7, 68,571. So we allocate that under rent, which is 68,571. That is allocated as a rent to product CC. Then the second one will be the allocation of the same rent to the next product, which is product WC. We are allocating the same amount, but now in the same ratio, of which the same ratio I'm referring to 3/7 now, no longer 4/4 or 4/7. Then we are allocating the same 120,000. Times this by 3 for product WC, divide by 7, gives me an amount of 51,429. 51,429. This is 51,429. So the 51,429 now is the allocation to the second product in terms of rental. Then now we have to go to the packing cost, the packing process cost. Then now they're telling us that when it comes to packing, they say finished units are packed. Remember, they are saying finished units, meaning our production, are packed on custom-made crates, of which for CC crates and WS crates. So now there are different crates for the different product, meaning each product has its own crate. They say one CC crate is packed with 8 units of product CC, and one crate of product WC is packed with 12 units of product WC. So now meaning we need to know the number of crates, meaning the number of 8 units that are in the total budgeted production, which is the 101 units that we budget to manufacture, because our budgeted production was based on the 101 units and 51,000 units. So now when you're calculating the number of crates, we'll calculate that based on these units, which will be 101,000 units. We divide this by 8 in order for us to get to the number of units that or the number of crates that we will be allocating to our products. 12,563, which is 101,000 divided by 8. Let me just confirm that. Let me just confirm that. Check. We have the company budgeted. So this is what the company budgeted. Take note, the company budgeted to manufacture 101,000, and they also budgeted to manufacture 51,000. And now under the APC, they are telling us that very clearly that our units are finished. Remember, finished goods are the goods that are already finished. In this case, we budgeted to manufacture 101,000. However, we actually manufactured 100,500. So these are not finished goods, but they are budgeted to be finished. So now the actual finished goods is 100,000 and 50,300. So please be mindful of that. It's also a mistake that I've just identified now, that we base this on the units that were actually finished, not the one that we budgeted to manufacture and finish. So that will be based on the 100,000 units, 500. We divide this by 5, then it gives us 12,562. So now we have to first calculate the number of crates. We need to calculate the number of crates for each product. Number of crates for product CC will be 12,563. 12,563, and for product WC, it will be, remember this was 100,000, 500 divided by 8. And we calculate the number of crates from the 50,000 300 units that the company budgeted or actually manufactured. 50,300 is product WC that was actually manufactured. Divide this by 12 and it gives us 4,192, which is 50,300 divided by the number of units in one crate. So now if we add the two, it will be 4,192 plus 12,563, which gives us 16,755 crates in total for the two products. Therefore, now we can start to do the allocation of a packing process. Then now we start allocating or allocation of packing cost. And the packing cost will be allocated to product CC. And we have to look at the cost of packing, if how much is the cost to pack. Obviously, the cost of packing will be 15,000 rands, which is that packing process of 15,000 rands that we are allocating to our two products. Then we say 15,000 times by the number of crates that we have, which is 12,563 divided by the total of 16,755, and that will give us the allocation of that 15,000 to product CC. This is 15,000 times by 12,563, divide this by 16,755, and it gives me 11,247. This is 11,247 of the cost that will be allocated to product CC. 11,247. Please don't forget to show the workings. I'm just doing them here now in my note. It will be 11,247. So now, as you have seen those calculations, 11,247. Then after now we do the allocation of the second product. Nothing changes, or not major, that will be a change. We only change the name of the product. We change the number of packing, which is number of crates, for 192, because we are still allocating the same cost. It will be 15,000 times by the number of crates, which is 4,192, divided by 16,755. Therefore, now this gives me 3,753. 3,753 will be allocated to product WC. 3,753. 3,753. And the total of the two will obviously have to give you 15,000. If you say 3,753 plus 11,247, you can see, okay, 11,247 plus 3,753, it should give us 15,000, exactly 15,000. Then now we allocate the last cost. We allocate now our last cost using the activity-based costing. Allocating the last cost using ABC, they are telling us that under number 5, that the quality inspection of units are strictly carried for as follows. Every 5th unit of CC is inspected, and every 8th unit, meaning on the 8th unit we inspect. So now we need to know the number of inspections. The number of inspections. If the company budget now to manufacture the units that they want to manufacture, which the company has manufactured the unit that they manufactured. So now it will be for product CC. The company manufactured a total of 100,500, because we are inspecting the product that will be, or that are manufactured. So now this is based on the actual production, not on the budgeted production, because we inspect a product that will go to the process of completion. So now, just get my calculator there. Then now it will be 100,000, 500 divided by 5, because every product, every fifth product is inspected. So now this will be 20,100, meaning 20,100 number of inspections, which was 100,500. Divide this by 5. Then it's 20,100. Second one will be 50,300 units that were actually manufactured. Divide this by 8. Then you say 50,300, divide this by 8. It will give us 610. Was it 8? Let me confirm that. For every fifth product and for every, yes, for every eighth for product WC. So I was correct. It will be 610, 6,289, 6,289, or 288, in fact, 6,288, 6,288. So now the total for these two products, total inspection will be 6,288 plus 20,100, which gives me 26,388 number of inspections. Then now I do the allocation. Product CC deserves to get its portion. Remember, the cost now of inspection, quality inspection, is 20,000. So that's what we are allocating. Then you say 20,000 times this by the number of inspections for product CC, which is 20,100, divided by the total of 26,388. So now at the end, we have to get to the 20,000. It's 20,000. Times that by 20,100, divide this by 26,388, and this gives me 15,234, 15,234, 15,234, 15,234 is the allocation for the first product. Second product will be using the most of the calculations. The cost will change, and here on top the number of inspections now will be for product WC 6,288. The total of the division will remain the same. Then we have 20,000 that we are allocating. Times this by 6,288, divide this by 26,388, and it gives me a total of 4,766. 4,766. It is 4,766. 4,766. Then now I can calculate all my total cost. Then I divide by the number of units in order for me to get to the total cost per unit. Then now this will give me, this will give me 12,500 plus 68,571 plus 11,247 plus 15,234, 15,234, and the total gives me 107,552. 552. Then the next one will be 12,500 plus 51,429, 51,429 plus 37,000 or 3,753 plus 4,766, and this gives me 72,448. 72,448. Then this will be the total fixed cost, which is actually fixed cost. Then we say units produced. My units produced was 100,000, here 500, and here we had 50,300. So we divide by this to get to the cost per unit, which is fixed cost per unit using the activity-based costing. So this will be 72,000 divided by 50,300, which gives me 1 rand 44 cents. For the first one, it's 107,552 divided by 100,000, 500. This is 1 rand 7 cents. Remember, the reason why we're taking into account the actual sales or the actual production, in fact, which is the actual units manufactured. And if you remember, in some of the calculations, we took into account the actual units that were manufactured, because we're allocating the actual fixed cost. So now actual fixed cost will be based on the actual production. So hence we use actual. If you remember, I highlighted that, but now I just remember, and now the reason why we are using the actual is because we were allocating the actual fixed cost. It said to us calculate the total, that was number B. Number B was based on the budgeted, hence we use budgeted information. But now under number C, we are using the actual information. So hence we took the 100,500 and we also took the 50,300 because this was the actual production and this was the actual production, not the 101,000 and 51,000 because that was budgeted. So now we go to number D before we close. Number D is just the calculation of the break-even point, which is budgeted based on the budgeted fixed cost for the year. So now we have to calculate first our contribution per unit. And remember, contribution per unit is selling price minus the variable cost. We already have our selling price per unit and we do have our variable cost, but our variable cost, they did not take into account selling and distribution. So now we just say selling plus distribution, or in fact selling and administration. Sometimes they will say selling and distribution. Our selling and administration, remember, there was a portion that was variable per unit, and they told us that it was 20 cents if my memory still serves me. There was selling and administration of 20 cents per unit. There we had our selling and administration, which was the variable part of that selling and admin, which was 20 cents per unit. So now that will be the part which was variable. Then now we took that, we have to take that 20 cents and we add it here, and we add that 20 cents here, so that we get to our variable cost. We get to our variable cost. We get to our variable cost total. Variable cost. This was variable manufacturing cost. Don't forget, this was variable manufacturing cost. So now we have taken into account our total variable cost, our selling and admin. Therefore now this will give us 26 rand 20 cents and 28 rand 20 cents. Remember, we still, okay, let me draw a line here. We still need to draw a line here indicating that these costs are separate. They are variable manufacturing and others are non-variable manufacturing. This one is variable and the rest is variable non-manufacturing. So we got our variable cost. Therefore now we have to just split the variable manufacturing and the variable non-manufacturing. Then after we added that, so we will get to our contribution. Our contribution, this has to be negative. Our contribution will be the selling price minus this part, minus our total variable cost. Therefore, now we have to say 30 Rand minus 26 Rand 20 cents, and it gives me 3 Rand 80 cents per unit. Then 35 Rand minus 28.20, and this gives me 6 Rand 80 cents. So now this is contribution per unit. So now the minute I get contribution per unit, I have to say times this by production mix. Times this by production mix. My production mix was 2:1. And after I have multiplied that by 2:1, I will get 6 Rand 80 cents here. And I will get 3.8 times this by 2. It will be 7 Rand 60 cents. Therefore, now this will be my contribution or contribution per unit, which is contribution or production mix per unit. This will be my production mix per unit or contribution also per unit, after we have taken now into account our production mix per unit. Then I will have to have our weighted no, this is not production mix, this is contribution per unit. This is weighted contribution per batch. Our weighted contribution per batch will be 7 Rand 60 plus 6 Rand 80 cents. 7 Rand 60 plus 6.8, and this will give us 14 Rand 40 cents. Now I just want to bring this to your attention because I might have triggered something to your mind by some random calculation that I did somewhere and I left them hanging, and I knew this will raise some points of concern. If you remember, there was some calculation of the fixed cost, and this was the fixed cost, the fixed manufacturing overheads. If you remember, it gave us that 3,950,170, and this I just left it like this because it just raised question, because we were already provided, remember, with the fixed manufacturing cost, and our fixed manufacturing cost was already given to us as 200,000. So now it was supposed to be in line with the opening balance, so I just ignore that. However, it was supposed to be in line or be the same as this 200,000, and if it's not the same, just ignore that, because our manufacturing overheads in this case, as I said to you, that another portion is fixed, another portion is variable. And this is for the 2016 financial year. They said manufacturing cost for units produced. This is for the 2016, which is for the unit that were actually produced. So this was supposed to be based on the actual information. But for that one, please ignore it, because they've already given us our fixed manufacturing overheads as 200,000. So ignore that calculation, but it just raises some question in terms of exactly which one must you take. Please take the one that is provided to you when it comes to fixed cost. And also the one that come from selling and administration, where we said 70% of this, which is 70,000, is another fixed cost. So now we have to take only the two and we allocate that. So now we have to calculate our break-even point now. Then that was number C. Then our break-even point, which is break-even units, or break-even point in units. Our break-even units will be 200,000 plus 70,000. Remember, for the 70,000, you have to tell the examiner where is the 70,000 coming from. And we did the workings of the 70,000. And we did show that the 70,000 is selling and administration, which is the 70,000 of 70%. So that was working number 3. If you say that to me, it's working number 3. So now I have to tell the examiner that the 70% of the 70,000 come from working number 3. The 200,000 was given, there's nothing to negotiate on that. So I divide this by contribution per unit, and I have to say C above, because the 14 rand is just above. This is the 14 rand 40 cents. So the examiner has to know where are the figures coming from. So that is C above. So now after that, I can strictly go forward to the calculation of my break-even point. So now I will get to 270,000, and I divide this by 14 rand 40 cents. So it will be 200,000 divided by 14 rand 40 cents, and this gives me a total of 13,889, which is my break-even point in this case. Let me just confirm if that calculation is correct. 270,000 divided by 14,000 40 cents. Okay, that is the accurate one. 18,750 units per batch, because it's for both products. So now I need it per unit. So for product CC, it will be 18,750, and I have to multiply this by the 2, which is the production mix, and WC, it will be 18,750. I multiply this by 1, which will give me 18,750 units. And for the second one, or first one, term that by 2, it will be 37,500 units. That will be at the break-even point. Remember, the 2 and the 1 is the production mix. 2 and the 1 is the production mix that was given to us. There, that was under note number 1. The budgeted sales mix, that was 2:1, or production mix. That will be that 2:1 that you always multiply with. Remember, that 2:1 is the one that you would have multiplied with also when it comes to this. This was the 2 and the 1 that would have multiplied with. So that's the same approach that we are using. You multiply by a production mix to the contribution. Then after we are done with this, we have to calculate the total of that, which is plus 18,750, and that gives me 56,250 units. So now this was requirement number C, and I go to the last requirement because I will not do the theory part of the question. So this was the requirement number C. Then now I go to requirement number, this was requirement number D. Then I go now to requirement number C. Remember, this was break even, which is inventory units. They said assume that there's no opening, calculate the total required budgeted units. So it's not value, it's the units. We just stop to the units. Now under number E, I need my sales price variance for the whole weight product. My sales price variance for the whole weight product. And now in less than 20 minutes, I will be done with the variance. So now this is number E, which is for the whole weight. It is the actual price minus the standard price, term this by the actual quantity sold. My standard price for the whole weight was 35 rand, and the actual price was 38 rand. Actual price was 38, standard was 35. So actual price is 38 and my standard was 35 times by actual quantity sold, which is the company sold as they budgeted. Remember, the budgeted sales were the same as actual. They said to us in the beginning, that was notes number 1. Notes number 1, they said that the company budgeted to sell 100,000 and they sold all of that, and they budgeted to sell 50,000 and they sold all of that. This is coming from this sentence. The actual sales volume were the same as budgeted. So the company had budgeted annual sales of 50,000 for product WC. So that's why now I have to multiply that by 50,000 units that this company actually sold. So now this will be 38 minus 35 equals, times this by 50,000, and it will give me 150,000 rands of the variance that is favorable. So this variance is favorable because we sold our inventory at a higher price than expected. Remember, once again, I want to bring you to the selling price. The selling price for the whole wheat was 35 rand per unit of the whole wheat. Selling price were budgeted 30 rand for CC and 35 for the whole wheat. And said throughout the year, product CC was sold respectively as budgeted. However, WC was sold at 35. This is the actual selling price, which was different from the budgeted selling price. So now, hence, there was a variance for the product whole wheat. Then now, that was the first variance that were required, which was Roman figure 1 and Roman figure 2. We proceed with that, and Roman figure 2 will be another variance that we are required to do. And the second requirement, which is Roman figure 2, is the direct material usage variance, and it's for the wheat, but direct material usage for the wheat usage. So we are mainly focusing on the wheat. So now we need to know how many kgs of the wheat are required to complete 1 unit. The wheat, we need to know how many kgs are required to complete 1 unit. And this was the wheat. And they said we require 5 kgs. However, the actual mixture was 0.6 kgs. So now we need to say standard quantities minus actual quantities, divide the times that by their standard price. So now we are doing that for the whole wheat usage variance. Whole wheat usage variance. And it will be standard quantities minus actual quantities times this by the standard price. This has to be per kg. Standard quantity, remember, it is actual production. Actual production was 50,300 for the whole wheat, times by actual quantities per kg, which is 0.5. Then this will give me that. Then my actual quantities, I have to check now. Actual quantity will be 0.6 times this by 50,300. Then after that, I have to multiply that by, there has to be 2 brackets, times that by the standard cost per kg. I have to multiply that by the standard cost per kg. And my standard cost per kg budgeted, they said the budgeted material cost per kg is 15 rand 34 cents. 15 rand, remember, this is whole wheat. 15 rand 34 cents. So this is what I will be multiplying with, 15 rand 34 cents. Remember, this is standard quantity. Standard quantity is equal to actual production times by standard quantities per unit, meaning the required material kgs or liters per unit. So now my standard kgs, meaning the number of kgs that I supposed to have used if I supposed to have used 0.5 kgs per unit. So standard is based on how many kgs you're supposed to have used. if it was based on the standard kgs per unit that you're supposed to take 0.5 kgs per unit. So now in this case, we say we're supposed to spend 0.5 kgs per unit, and we actually manufactured 50,300 units. So now how many kgs were supposed to be used based on the standard kgs per unit? Then we say 0.5 times this by 50,300, and this gives us a total of 25,150. Then after we subtract the actual, we actually use 0.6, not 0.5. So now we're supposed to have spent 0.5 per unit, but we actually spent 0.6. So now we say 0.6 times by 50,300, and this gives us to 30,180 kgs that we actually used. Times this by 15.34 minus 25,150. And we term this by 15.34, and it gives us 77,160. This is 77,160, and this variance is favorable. This variance will be a favorable variance unfavorable variance, because I use the small from the big one. That will be unfavorable variance. When I calculated now, I deducted 30,000 from 25,000. So now this is how we calculate our usage variance. You must know how to calculate the standard kgs. Remember, standard kgs, you say based on the standard information, how many kgs or liters am I supposed to mix for 1 unit? And I say I'm supposed to mix 0.5. Then the question is again, how many units were actually manufactured? I manufactured 50,300. So now if I was supposed to use 0.5 per unit, so now how many units were supposed to be manufactured out, how many kgs were supposed to be spent out of the 0.5 standard kgs per unit? Then now that will give you standard quantities. Actual will be calculated based on the actual information. Then now we go to Roman figure 3, as I am closing the question, summarizing now to Roman figure 3 and 4 and 5. Then after I will be done with you. Then after, it's only up to 4. Then we go to the labor rate variance for the whole, for the CC con cereal. If you remember, I think I still have this. Yes, my rate went up by 5%. Previously the rate was 50 rand, but for the whole wheat they said it will go up by 5%, where they said the actual direct labor rate was higher by 5% than the budgeted direct labor rate per unit. So that was for both of them. But now they say let us do it only for the whole wheat product. So now we all know that standard was 50 rand, actual was 52 rand 50 cents. So that means we have to do labor rate variance. Labor rate variance, and our labor rate variance will be the standard rate minus the actual rate times that by actual hours. Our standard rate was 50 rand. Our actual rate went up by 5%, which became 50 rand 50 cents, times by that by actual hours. Remember, now we are not provided with actual hours, but we are provided with actual production, where the company actually manufactured 100,500 units. So we need to know how many actual hours does it take to complete 1 unit. They said to us that the actual direct labor minutes per unit were equivalent as budgeted direct labor minutes of the two products. So now for the product CC, we budgeted to spend 12 minutes per unit, and it was the same as the actual. So now we spent the same 12 minutes, meaning our employees were very efficient. So we term this by 12 minutes over 60 minutes in an hour to get to the actual hours. So it's 50 minus 52.50. Term this by actual hours. Actual hours will be 12 over 60. Term this by 100,000. 500 was the actual production, and this gives us 20,100 hours. Let us confirm that our actual production is 50,500 units. Always is good to affirm in this type of exercise. So now we had our actual units produced, 100,500 for product CC and 50,300 for product WC, but we are only doing for the corn cereals. So this will be times that by 2.50, which gives us 50,250, and this variance is definitely unfavorable. And the reason why it's unfavorable is because we plan to spend 50 Rand per labor hour, but we end up spending 52 Rand per labor hour. This could be just because of wage increase, or maybe there was a strike from employees demanding a higher wage. And maybe the company decided to increase the higher wage. So now whatever the company budgeted to incur on wages was no longer the same as actual, because of the increase in the wage rate. So now we go to the last one. I will not do the theory part in the question because you can just read the theory for yourself. I mainly focus on the calculations. So now, meaning under number F, where you have to discuss the difference between quality cost and target cost, and discuss the difference between direct and absorption, you can just go and read that down. I'm only going to touch based on the last one, which is the fixed manufacturing overheads expenditure variance. And remember, our fixed overheads variance will definitely be 20,000. And the reason why it will be 20,000 is because there is a difference of 20,000 because of budget was 200,000 and actual was 180,000. So now our fixed expenditure variance is, as I said, that one of the easy variance. Fixed expenditure variance, and is favorable. It will be budgeted fixed cost minus actual fixed cost, and our budgeted fixed cost was 200,000 and our actual fixed cost was 180,000, and the variance on that will be 20,000 favorable. And this will be the end of this question. If I have any mistake that I've made perhaps, and you see this video on YouTube, please do send your comments. Then I'll appreciate your comments to correct any mistake that I might have done. Otherwise, thank you, and I hope you have learned something on this video, and God bless you. Thank you, ladies and gentlemen.